Welcome to Chapter 13, Other Retirement Planning Options. Chapter 12 focused on the workplace plan. This chapter widens the lens to the household. Retirement decisions now have to connect traditional and Roth IRA accounts, employer plan balances, rollovers, Social Security, pensions, taxable assets, annuities, required distributions, health costs, and the very practical question of how to replace a paycheck. The hard part is not finding products. The financial industry has never suffered from a shortage of products. The hard part is assigning each resource a clear job and understanding the trade-offs. A rollover can improve flexibility while increasing cost. A Roth conversion can improve future tax flexibility while creating a tax bill today. An annuity can transfer longevity risk while reducing liquidity. A cash reserve can reduce forced selling while creating return drag. We will trace the operating process behind these decisions and then build a household retirement income framework. The central idea is that retirement is not one investment account reaching a magic number. It is a coordinated system of spending, taxes, guarantees, liquidity, market risk, longevity, and behavior. Accumulation is mostly about adding money and allowing it to compound. Retirement reverses the cash flow. The portfolio is now expected to distribute money while markets, inflation, taxes, health costs, and longevity remain uncertain. That change makes sequence, risk, liquidity, and income reliability much more important. At the end of the first quarter of 2026, United States IRA assets were estimated at $18.2 trillion. Mutual funds held about $7.3 trillion, or roughly 40%. The regular 2026 IRA contribution limit was $7,500 before the age 50 catch-up, and required minimum distributions generally began at age 73 for many owners under current rules. Those figures show the scale of the system, but they do not tell us whether one household is secure. A retiree with $1 million may be well prepared or badly underfunded depending on spending, pensions, Social Security, taxes, allocation, health, and life expectancy. Retirement replaces one paycheck with a committee of accounts, tax rules, insurance contracts, and future you. Unfortunately, future you rarely attends the planning meeting, so current you has to leave clear instructions. This chapter develops 4 practical skills. First, compare the major retirement wrappers and tools. You should be able to distinguish traditional and Roth IRA accounts, rollovers, small employer plans, annuities, employer plans, and taxable accounts by tax treatment, access, cost, protection, and investment choice. Second, trace the operating process. That includes direct transfers, 60-day rollovers, withholding, account opening, registration, investment implementation, beneficiary elections, and reconciliation. Third, evaluate the decision. A recommendation must consider taxes, fees, investment quality, services, liquidity, legal protections, and conflicts, rather than focusing on one attractive feature. Fourth, design a retirement income framework. The framework should address essential spending, flexible spending, sequence risk, cash reserves, longevity, inflation, required minimum distributions, tax location, health costs, and behavioral sustainability. Notice the progression. Compare the tools, trace the transaction, evaluate the trade-offs, and design the system. By the end of the chapter, you should be able to explain not merely what a product does, but what household problem it solves, what it costs, and what new risk it creates. 4 connected questions organize the chapter. First, which wrappers are available? Traditional IRA, Roth IRA, SEP, Simple, 403B, 457, Annuity, employer plan, and taxable account all create different rules around taxes, access, and protection. Second, what transition is occurring? A job change, rollover, Roth conversion, retirement, a beneficiary transfer, or required distribution can create operational and tax consequences before the investment decision even begins. Third, how will income be produced? Social Security, pensions, systematic withdrawals, annuitization, cash reserves, and tax sequencing may each play a role. Fourth, what can go wrong? Poor market sequence, longevity, inflation, health costs, complexity, fraud, taxes, and bad advice can all undermine the plan. These are not separate chapters hiding on one slide. The wrapper affects the tax result. The transition affects the available choices. The income rule affects the portfolio risk. The risks determine how much flexibility or guarantee the household needs. A retirement plan is therefore a set of coordinated cash flow and risk decisions. Product selection comes after that map, not before it. No single account has to solve every retirement problem if the components are intentionally coordinated. Social Security can provide inflation-adjusted lifetime income, influenced by claiming age and work history. A pension can add dependable income and may include survivor or inflation features. Employer plans and IRA accounts can provide tax advantage growth, liquidity, and investment choice. Annuities can transfer selected longevity or market risks, but only in exchange for cost restrictions and ensure exposure. Taxable assets can support emergency liquidity, favorable capital gain treatment, charitable gifts, and legacy goals. Home equity, business interests, insurance, and part-time work may also matter. The planning mistake is to treat every dollar as interchangeable. A Roth dollar, a traditional IRA dollar, a taxable dollar, and a pension promise do not behave the same way. After taxes or under stress, good planning assigns roles. Dependable income may cover essential spending. Liquid assets may cover emergencies and discretionary goals. Growth assets may support inflation protection and legacy. The allocation across wrappers can be as important as the allocation across stocks and bonds. Asset allocation tells us what we own. Wrapper allocation helps determine what we get to keep and when we can use it. A rollover is not merely paperwork. It is a recommendation about the investor's future operating environment. Start with inventory. Identify the plan balance, traditional, Roth, and after-tax sources, outstanding loans, company stock, fees, services, restrictions, and beneficiary information. Next, compare the reasonable alternatives. Remain in the current plan. Move to a new employer plan. Transfer to an IRA. Use an annuity where appropriate or take a taxable distribution. Third, analyze taxes. Direct rollovers, 60-day rules, mandatory withholding, Roth conversions, penalties, and net unrealized appreciation can create very different results. Fourth, document why the choice fits. Compare investments, total cost, advice, protection, liquidity, service, and conflicts. Fifth, transfer carefully. Trustee to trustee movement usually reduces the opportunity for a check to become an expensive souvenir. Verify the account type and registration before assets move. Finally, reconcile. Confirm cash and securities, source data, cost basis where relevant, beneficiaries, residual balances, and the actual investment allocation. A rollover that lands in cash and remains there for 6 months is not complete simply because the paperwork says complete. The control ends when the household's intended strategy is actually operating. Retirement wrappers differ by eligibility, taxation, contribution rules, investment choice, cost, access, and protection. A traditional IRA may provide a deductible contribution depending on income and plan coverage, tax-deferred growth, taxable withdrawals, and required minimum distributions. A Roth IRA uses after-tax money, can provide tax-free qualified withdrawals, and has no lifetime required minimum distribution for the original owner under current rules. ASEP-IRA is often used by self-employed individuals and small businesses and is generally funded by the employer. A simple IRA combines employee salary reduction with a required employer contribution under plan-specific rules. 403B and 457 plans serve eligible nonprofit, educational, governmental, and other workers, but their withdrawal and plan rules are not identical. An annuity is an insurance wrapper that may add tax deferral or guarantees together with riders, surrender schedules, expenses, and ensure credit exposure. The key distinction is between the wrapper and the investment. The account determines much of the tax and access treatment. The mutual fund, ETF, security, or sub-account inside it determines market exposure. A tax advantage wrapper cannot turn a poor investment into a good one. It merely changes how the poor decision is reported to the IRS. Traditional and Roth IRA accounts move the tax decision to different points in time. A traditional contribution may be deductible, earnings generally grow tax deferred, and taxable withdrawals are usually ordinary income. Required minimum distributions generally apply to the owner. A Roth contribution is not deductible. A conversion usually creates current taxable income, but qualified growth and withdrawals can later be tax-free, and the original owner does not face lifetime required minimum distributions under current law. The simple classroom answer is to compare today's tax rate with the expected future rate. Real planning is less tidy. The household also has to consider available cash to pay conversion tax, Social Security taxation, Medicare premiums, required distributions, charitable goals, estate plans, beneficiary tax treatment, and legislative uncertainty. A conversion can be attractive during a temporarily low-income year or after a market decline, but a larger conversion is not automatically a better conversion. It can fill higher brackets and create secondary costs. Tax diversification may therefore be more useful than an all-or-nothing forecast. Predicting tax law 30 years from now with absolute confidence is not planning. It is fan fiction with spreadsheets. A sound plan uses current rules, reasonable scenarios, and flexibility. Retirement sustainability is not produced by one universal withdrawal percentage. It depends on resources, flexibility, guarantees, spending, taxes, and adverse shocks. Resources include the portfolio, Social Security, pensions, annuities, work, home equity, and insurance. Flexibility is the ability to reduce discretionary spending, delay a purchase, work longer, change the withdrawal amount, or adjust a claiming decision. Guarantees can reduce dependence on the market, especially for essential expenses. Shocks include poor early returns, longevity, inflation, health costs, family obligations, taxes, and unexpected repairs. The familiar 4% initial withdrawal is a planning convention, not a contract signed by the market. A household retiring into strong returns may be able to spend more. A household facing an early bear market may need to reduce withdrawals or use buffer assets. Fees, taxes, asset allocation, horizon, and willingness to adjust all matter. The goal is not to discover a magic rate that never changes. It is to create a rule the household understands, can monitor, and is willing to modify when conditions change. A retirement plan should behave less like a vending machine and more like a thermostat. It responds to the environment instead of dispensing the same amount forever. Two retirees can earn the same average return and experience very different outcomes because withdrawals make the order of returns matter. An early market loss forces the retiree to sell more shares to fund the same spending. Fewer shares remain to participate in the recovery. During accumulation, a decline may allow new contributions to buy at lower prices. Retirement reverses that cash flow. The investor is now removing capital when prices may be depressed, Buffer assets can reduce forced selling. Cash, short duration bonds, dependable income, or a planned bond ladder can fund near-term spending while risk assets recover. Dynamic spending can also help. Guardrails, percentage-based rules, or temporary reductions after poor returns preserve more capital than a completely rigid rule. Asset location and withdrawal order add another layer. Because traditional Roth and taxable withdrawals affect taxes, required distributions, Medicare premiums, and the future mix of the portfolio. Finally, the plan has to be behaviorally usable. A theoretically elegant rule that the retiree abandons during the first frightening headline is not elegant in practice. The same portfolio can be sustainable under one withdrawal rule and fragile under another. Average return tells part of the story. The path determines whether the investor gets to remain in the story. An annuity should be decomposed into the insurance protection, investment exposure, riders, restrictions, costs, and insurer credit behind the contract. An immediate income annuity exchanges a lump sum for scheduled payments, potentially for life or a guaranteed period. A deferred variable annuity provides market exposure through sub-accounts while adding insurance charges and optional living or death benefit riders. Fixed and index contracts use insurer guarantees and crediting formulas that may include caps, participation rates, spreads, or market value adjustments. Riders can address lifetime withdrawals or death benefits, but they add cost and conditions. Surrender schedules can make early exits expensive, and tax treatment may differ from ordinary investment accounts. Most importantly, the guarantee depends on the claims paying ability of the issuing insurer and applicable protections. Annuities are neither automatically good nor automatically bad. They can be useful when a household values dependable lifetime income and can give up some liquidity. They can be poor fits when the investor needs flexibility, misunderstands the contract, or pays for guarantees that do not address an actual risk. Insurance contracts love footnotes because the footnotes are where the product admits it has a personality. The investor should understand that personality before committing long-term capital. At the end of the first quarter of 2026, total IRA assets were estimated at $18.2 trillion. Mutual funds held approximately $7.3 trillion, representing about 40% of the total. Bank and thrift deposits accounted for roughly $1 trillion. Life insurance products accounted for about $600 billion. The remaining $9.3 trillion fell into other assets, including ETF shares, individual stocks and bonds, brokerage cash, annuities, and other investments across many custodians. 3 observations matter. First, the IRA is not one product. It is a tax wrapper capable of holding many products. Second, mutual funds remain central, but they are not the entire IRA market. Third, the asset total reflects decades of direct contributions, employer plan rollovers, conversions, investment returns, and inherited accounts. The scale creates commercial opportunity for fund companies, advisors, custodians, insurers, and platforms. It also magnifies the importance of fees, conflicts, cybersecurity, beneficiary records, and rollover quality. $18.2 trillion is a large retirement pool. It is also a large collection of individual households that do not experience the average. Every account still needs a purpose, an allocation, and an operating plan. Retirement policy has expanded access while making coordination more demanding. In 1974, ERISA established the modern individual retirement account. In 1997, the Roth IRA added an after-tax contribution structure with potentially tax-free qualified distributions. Legislation in 2001 expanded contribution limits and retirement saving incentives. In 2010, the income restriction on Roth conversions was removed, making conversion planning available to more households. The Secure Acts enacted from 2019 through 2022 changed required minimum distributions, inherited account rules, workplace access, annuity provisions, and other retirement features. In 2026, the regular IRA contribution limit rose to $7,500 with an indexed catch-up for eligible older savers. The durable lesson is not to memorize one threshold forever. Thresholds change. Eligibility changes. Required distribution ages change. Beneficiary rules change. The durable principles are to identify the account type, confirm the current rule, model the tax consequence, preserve documentation, and coordinate the result with the household plan. Retirement law is a moving target with excellent job security. Education should separate the stable decision framework from the current number that may be different the next time the course is taught. Consider the departing employee with $420,000 in a low-cost 401k plan. The plan offers institutional index funds, a stable value option, and limited planning support. An advisor recommends an IRA with broader investment choice, ongoing planning, and a 1% asset-based fee plus fund expenses. The recommendation may be reasonable, but it needs evidence. 1% of $420,000 is $4,200 in the first year before fund expenses, and the dollar fee can grow with the account. What services will the household receive for that cost? Will the advisor build a tax and withdrawal plan, coordinate beneficiaries, rebalance, coach behavior, and monitor the household? Or will the account simply hold similar index funds in a more expensive wrapper? Compare the existing plan's institutional pricing, stable value, creditor protections, loan treatment, service, and withdrawal rules with the IRA and any new employer plan. Evaluate actual investments, not the number of items on the menu. 5,000 choices are not automatically better than 10 good ones. Finally, disclose the conflict. The advisor is paid more if the assets move. That conflict does not prove the recommendation is wrong, but it makes comparison and documentation essential. Choice has value, so does keeping the receipt. This matrix illustrates a basic retirement trade-off. Social Security and traditional pensions generally provide strong lifetime income characteristics with limited liquidity. An immediate income annuity can also provide a strong guarantee, but the investor usually gives up access to the premium and some bequest flexibility. Variable annuities occupy a middle area because market exposure, riders, contract terms, and surrender schedules change the balance between flexibility and guarantee. A bond ladder can create predictable maturities and near-term cash flow, but it is not a lifetime promise and still carries interest rate, credit, and reinvestment risk. A total return portfolio offers the greatest flexibility and legacy potential, but the retiree bears market, sequence, and longevity risk. No item has one permanent coordinate. Inflation protection, survivor options, insurer strength, credit quality, withdrawal features, and household circumstances can move it. The planning insight is to combine tools rather than force one product to solve incompatible objectives. Essential spending may justify stronger guarantees. Discretionary spending, emergencies, and legacy may require liquid assets. Retirement planning becomes easier when every tool has a job description. Problems begin when one product is hired as chief executive, emergency fund, growth engine, tax strategy, and estate plan all at once. The retirement income sequence begins with spending and risk, not product selection. First, separate essential, flexible, health, one-time, and legacy goals, and estimate which expenses are sensitive to inflation. Second, build the income floor. Map Social Security, pensions, annuities, and other dependable cash flows against essential needs. Third, establish liquidity for near-term spending, emergencies, taxes, and known obligations. Fourth, design the portfolio. Choose the asset allocation, account location, rebalancing method, fee budget, and withdrawal rule consistent with risk capacity. Fifth, coordinate taxes across traditional, Roth, and taxable assets. required minimum distributions, charitable strategies, and beneficiary goals. Sixth, review the plan. Markets, spending, health, family circumstances, laws, fraud risk, and cognitive ability all change. A retirement strategy should specify what happens after a bad market, an unexpectedly long life, a large health expense, or the death of a spouse. That is where vague plans tend to become expensive. The framework should name decision rules, responsible people, and review points before stress arrives. A good fire drill is designed before the building fills with smoke. The same is true of a retirement income plan. Now, apply the framework to the newly retired couple, ages 67 and 65. They have $1.4 million, approximately $980,000 in traditional retirement accounts, $140,000 in Roth assets, and $280,000 taxable. Social Security covers 55% of essential spending. The advisor proposes a partial Roth conversion, 2 years of cash reserves, a 55-45 portfolio, and placing 15% of total assets, or about $210,000, into a joint life income annuity. Do not approve the package as one bundle. Test each component. What is the annual spending gap after Social Security? And how much cash does 2 years actually require? What tax bracket, Medicare premium, required distribution, charitable, and estate facts determine the conversion amount? What income would the annuity purchase? What survivor and inflation features apply? And what liquidity or bequest value is surrendered? How does the portfolio respond to a 25% equity decline in year one? What happens if one spouse lives to 100 or needs long-term care? The recommendation should connect each action to a specific risk and identify what would cause the plan to change. Pause the video and prepare one recommendation, one calculation, one material risk, and one additional fact you need before deciding. Pause the presentation and answer all 4 questions before continuing. Question 1. What is a direct rollover? The correct answer is movement from one eligible retirement arrangement directly to another. The participant generally does not receive the money personally, which helps avoid withholding and reduces the risk of missing a deadline. Question 2. What is sequence of returns risk? The correct answer is the effect of early market returns when withdrawals are occurring. The same average return can produce a very different result if losses arrive early and the retiree must sell assets. Question 3. What is a central trade-off of an income annuity? The correct answer is lifetime income potential in exchange for some liquidity, control, cost, and possibly bequest value. It does not guarantee market outperformance, and the insurer's financial strength still matters. Question 4. What should precede a rollover recommendation? The correct answer is a comparison of the relevant plan: IRA, tax, cost, investment, service, protection, liquidity, and conflict facts. Choosing a new fund comes later. Closing the old account first is not a strategy. A market forecast is not a substitute for due diligence. Review any item you missed and explain the operating logic behind the correct answer rather than memorizing the letter choice. Carry 6 claims forward. First, IRA accounts are a major retirement hub. They receive contributions, rollovers, Roth conversions, inherited assets, and many types of investments. Second, the wrapper and the investment are different. The account controls much of the tax and access treatment. The underlying assets determine market exposure. Third, rollovers require comparison. Cost, investment quality, protection, service, taxes, liquidity, and compensation conflicts all matter. Fourth, sequence risk is real. Withdrawals make poor early returns more damaging than the same returns during accumulation. Fifth, guarantees have a price. Annuities and pensions can transfer selected risks while reducing liquidity, control, or legacy, and adding contractual complexity. Sixth, retirement is a system. Coordinate income, spending, taxes, liquidity, portfolio risk, longevity, beneficiaries, and review. No single product deserves every job on the retirement team. The objective is not to find the account with the most features or the contract with the longest brochure. It is to build a plan whose components have clear roles and whose decision rules can survive an ugly market and an unexpectedly long life. Chapter 14 moves behind the investor experience to the fund operating system that makes daily transactions, valuation, settlement, and shareholder records possible. This final page is the refresh register for Chapter 13. Posen and Hamacher provide the operating architecture. Investment Company Institute data update the scale and composition of IRA assets. IRS resources support contribution limits, required minimum distributions, and rollover mechanics. Investor.gov materials explain variable annuity structure and risk. FINRA guidance frames the comparison expected in an IRA rollover recommendation. Department of Labor, Retirement Income Resources ad plan and fiduciary context. Do not read the long web addresses aloud. Instead, notice what each source can prove. Official statistics can describe market scale. Tax guidance can establish current thresholds and operating rules. Regulatory guidance can identify expected process, disclosure, and conflict analysis. None of those sources alone proves that a conversion, rollover, annuity, or withdrawal strategy is right for one household. That conclusion requires current facts about spending, taxes, health, family, investment risk, services, cost, liquidity, and behavior. The durable questions are straightforward. What problem is being solved? What resources assigned to it? What tax or contract rule applies? What is paid? What flexibility is surrendered? What could go wrong? And how will the plan respond? Chapter 14 now follows the transaction into fund operations, where one daily NAV depends on a remarkably large number of systems agreeing with one another.